Good morning, everyone. We have Tracey Lassere back with all things mortgages. So, a lot of stuff going on in the mortgage market right now. We've seen multiple increases over the last several weeks, and Tracy's going to kind of jump in and tell us what the heck is going on and what can we expect moving forward. First off, thanks so much, Tracy, for joining us. Appreciate you jumping.
Hi, thank you for having me. So everyone probably heard that last week the Fed is raising short-term rates. They said that they will do that for all six sessions this year, but that's not what had a negative impact on mortgage rates going up. And for those who don't know, mortgage rates have been steadily climbing since January 1 of this year. And last week we saw a huge spike, and every day since then, rates have been ticking upwards. Um, what really happened that affected mortgage rates last week is the we were artificially rates were artificially being kept down, and then the spike that we saw last week from 2 to 2.35% on the 10-year Treasury was related more to that than the Fed raising the short-term rates last week. So basically, what happened is the Fed stopped buying mortgage-backed securities, and those mortgage-backed securities is the buying of that is what helped keep rates so low. So where we were in the twos and threes before, we're getting closer to the fours. There's talk about us being in the fives and sixes at some point this year.
Ooh, and we're gonna jump into that. That's mighty crazy. I mean, even a month and a half ago, low threes was the norm. Low to mid fours is the new norm right now. And I think we are still on the real estate side, at least market wide. Last month, we always kind of look forward. What are the leading indicators moving forward? And the first one that we look at is how many homes come on the market. That number was actually down, believe it or not, February over February, and the homes coming off the market was up a point and a half. So that's about a 10% spread, which pushed available inventory down even further. So naturally, kind of what's happening is demand's outpacing supply, so it's moving even faster. I like to give the analogy of kind of like a car lot. A lot of these guys look like they're out of business because there's no vehicles on the lot. And when things are coming on the market, if you don't make a decision right now, somebody else is going to end up making it for you. So the only way for this to turn around and see prices drop is demand being outpaced by supply month over month over month over month over month, like we've seen. The flip side of it coming into the pandemic and moving in right now. So we've got a long way to go before we end up seeing pressure on prices. And I think one thing that I think would be valuable for people to learn is, what does that look like? The effect of interest rates now. We're pretty close. Are we pretty close to where we were before pandemic? The pricing right now.
Yeah, we're about there, and it's ticking up. Potentially higher than where we were right before COVID hit.
So let's do this. We're gonna go and I'm gonna jump in. I'm gonna throw your screen on the into the mix here, so you can explain what's going on with all this
Okay.
stuff. So what does all this mean? This looks like the Matrix. So you're gonna have to break it down for the simpletons like me that don't believe.
There are two things I want to bring up here, and it all comes down to buying power and how a rise in interest rates can affect your buying power, not only from a monthly payment basis and how much you actually want to spend and have budgeted for, but also from a qualification and a debt to income uh, perspective. So this is just one example. This is just a basic conventional loan, fixed rate, 30 years. The purchase price is 300,000, down payment of 20%, which brings you to a loan amount of $240,000. So if rates today are around 4.5 for a 30-year fixed, your monthly payment would be around 1216. Okay. I added just some basic income and some basic average debts in here just to calculate an example of a debt to income ratio. So
So I'm gonna pause you real quick, just for folks that are there that don't see this. There's two numbers on debt to income, which is the DTI, which is a DTI number next to loan amount of 240.
Yeah.
So we got here $300,000 purchase price. Somebody's putting 20% down. The loan amount's 240. And we got DTI 24 and a DTI of 43. What's the difference between those two, and what do you guys look for?
On conventional, that front ratio isn't as big of a deal. I mainly concern myself with this back end ratio, and what the back end ratio is, it's the proposed monthly payment or housing expense on a monthly basis, plus all of your monthly debts that you would see on a credit report divided by your monthly income. So on a conventional loan with a strong borrower, the max debt to income ratio is 49.99%. Okay. So this example file is already close. And I just wanted to show what a bump in rate will do to the monthly payment and the debt to income ratio. So I'm going to show a few examples here. So if rates go up to 5%, keeping the same purchase price and loan amount, that's going to bump that payment up over $70. Okay. It's going to bump the DTI up also. DTI is still in line with a strong borrower.
And one other thing too, I mean, we went from 1216 to 1288. So that's $72. If you take that over the life of the loan, that's almost $26,000. So right away, if you stay in the house from the time you buy it to the time you sell it, or the time you pay it off, you don't make any extra payments. $25,920 extra that you just threw to the bank. All right, continue.
So to push it a little bit further, and I'm going to go back to that 4.5 and compare it to something else, but I want to keep pushing this rate up. So let's say we bump it to 5.5. Okay. Now your payment jumps up to $1,362. And again, like you said, that overall interest and monthly payment that you're making over a life of 30 years is a big impact. And then that bumps the debt to income ratio up to above 46%. But I'm going to go back to what you and I were talking. Do you want me to jump to 6?
So that one, $146 a month payment over the course of a 30-year fixed, $52.5 is the extra interest paid for the cost. Okay, go ahead. Go ahead to 6. Just for giggles. Yep. We're inching dangerously close to the that 49.9.
Yeah. And I also want to mention, this is just principal and interest only. This does not include property
taxes, insurance. Yeah.
Okay. So keep that in mind.
For those that are listening in, taxes and insurance are going to vary quite a bit. So if you're inside city limits, you're going to have more property taxes. If you've got an older house, you're going to have higher insurance. If you've got both your monthly payment's going to end up going up a good bit more. So
something else to keep in mind.
Consistent.
Yeah, with all these storms that have come through over the past few years, insurance is only becoming more expensive. So that's another part of the budget that will be higher than it typically was. So that can have a major effect on the monthly payment and the debt to income ratio. So when we bump this rate up to 6%, same scenario, monthly payment jumps to $1,438, and then look at how high this DTI is. And we haven't even added taxes or insurance yet. So these people basically, unless they want to buy a less expensive home and or put more money down, they're not going to qualify.
Yep. That also adds 80 grand to the life of the loan too. So a lot of the funds that are going out. So one of the other, I'm going to, I like arguing both sides of the coin here. So if we're running into people that we're seeing an increase in interest rates, we're seeing an increase in building materials. A lot of people have been asking me, well, Robbie, if interest rates are going to go up, does that mean that the market's going to crash? And not necessarily. We still have we're going to have a little bit, it's a potential to be a little bit of downward pressure, but right now cost of building materials is not going down by any time soon. So
Yeah.
it's going to end up being, this is what it is, or there's nothing getting built. If we are seeing, and again, to talk out of both sides, month over month for the last 2 years. So January versus January, February versus February, March versus March. We've seen an increase in average sales price of 8 to 10% throughout the pandemic. That's not a consecutive, it went up from 10% to January to March to April. It was month over month. So if we're gonna use this kind of same example, people are like, man, if I wait for prices to fall, what happens? I'll be able to get this house a little bit cheaper. So if that's the case, let's use, let's say we went down the exact same amount as what we've averaged going up month over month. So this $300,000 house is now 270, and we're going to still put 20% down, and we're going to be buying it at 5.5%, because by then, we're going to have several months of our listings coming on the market outpacing the homes coming off the market. This is not anything that's going to happen overnight. And what we're more than likely going to end up seeing is the next couple of months, while interest rates are right here, there's going to be more of an influx, because now is a sense of urgency to be able to actually make that move, because they're going up and they're going to be coming up quick, and they're going to be there for a good while. So 5.5%, you guys remember at 300,000 at a 4.5% rate, our monthly payment without taking property taxes and insurance was $1,216. Right here, Tracey.
Yeah, so you're buying $30,000 less, okay, lower purchase price, bumping that rate up by a full point to 5.5, and the payment's $10 more than it was at 300,000.
We use the same. What happens if we end up going into 6% for interest rate? So we went from $1,216 today at a more expensive house to $1,295, or $1,295, $1,296, so about $80 a month more by sitting around and waiting price points to go down and the interest rates to potentially go up.
So
both of these are. What's that?
Waiting will cost money in the long run.
Yep. Cost you more money in the long run. So, I think what I'm running into a good bit is I'm seeing folks like, I'm going to wait for prices to drop and wait for prices to drop, wait for prices to drop. And, the only way that ends up, you're going to end up waiting to be able to pay the bank a little bit more money. You may pay a little bit more in the price point, but over the life of the loan, if you're going to be using the bank's money, which 4.5% is still pretty darn good right now. We've been spoiled rotten for the last 2 years, seeing stuff in the 2s and 3s, and I think it's like trying to you can't really catch a falling knife when you try to catch some of these things at the very bottom of the market for the interest rates, but it's still cheap money, and it's still something that I think people need to be taking advantage of while it's out there.
Agreed. Yeah. So if you're thinking about buying, just like you said, it's not the time to wait. It's just going to cost you more money at the end of the day.
So take advantage of the ones that are out there right now. If you're in the market and you're looking at homes right now, I've always advised that people need to be very intentional. They need to be very intentional about what their must-haves are, their needs versus their wants. Things depending on what price ranges you're in. We're still looking at multiple offers on lots of houses. I've had quite a few buyers over the last couple of weeks, even with this increase in interest rate, have been missing out on houses because they either didn't act fast enough. They decided to stick around and wait, and that's fine. We want to make sure everybody's okay. But the reality of the situation is right now, if you can't make a decision and you're not steadfast in what your must-haves and your wants are, and being able to make that decision right away, you're missing out. That's just how it is. So
yeah, and I want to say too, it's very important to, and you can speak to this, to get properly pre-qualified with a lender, preferably with a local lender, and be quick to get your lender what they need from you, because, and you talk about this, but most sellers and listing agents probably don't want to deal with those big box out of town lenders. They prefer to work with someone who's local, who they work with and trust. And they don't want to show homes to people who aren't qualified whenever the market's so crazy right now.
I love to give the example of the folks that are coming in with somebody that's from out of state on an 800 number. When the lender is local, I know where you work and I can go over to your office and you cannot run away from me. We may not like the answer, but if you think about it, the 800 number, if we say on hold on this big box mortgage broker, that's 1-800 whatever. It's the difference between who's got more patience, the person that's going to get lunch while they have an angry real estate agent that's not getting answers for their buyer, or their buyer that can't get answers that's sitting on hold, or the guy that's getting the coffee in the other room laughing about the angry guy that's eventually going to hang up. So
yeah. Having
somebody local, and look, I've seen quite a few sellers that receiving multiple offers that we've been negotiating ourselves. If you are out of town or nobody knows who this particular lender is, and all things are equal, you're going to lose if you're going to be dealing with that out of town lender. There's going to be a cost of, or an advantage to somebody that's got a reputation for getting the deal done versus I don't know who the heck you are or where you're from, and whether or not you're capable of pulling anything off. So, not saying that it's impossible to get it done, but you're definitely not stacking the deck in your favor if you're competing with everybody else that's out there. So
I've definitely seen a lot of contracts come across my desk in this office where our clients have gotten the deal over someone else because of who their pre-qualification was with.
And look, as a listing agent, same thing. I'm pushing local because I know who that person is versus being out of town. So again, we've been jumping on. Thank everybody for being here. Tracey, thanks so much for joining us.
Thank you.
It's quite a bit of things to be able to digest. A lot of stuff that's out there, and of course, if they have any questions, they can always reach you. Tell them where to find you.
You can give me a call at 337-456-8741. You can text me there as well, and I can take it from there.
Awesome. Thanks so much for joining us.
Thank you. Bye.
Bye.